Good morning. Welcome to our regular second Saturday webinar. We will start the webinar now. Markets continue to see consolidation. This is the 18th month continuing. The market is under consolidation. The major events in the last 1 month, if you see, means the yield curve in our bond market has inverted. I will tell in detail what is meant by yield curve inversion in coming slides. Then globally, if you see, Fed commentary continue to remain very hawkish. They continue to tell that interest rates are going to be higher than expected and higher than what it was normally forecasted previously. And they are expecting the high interest rate to remain there for quite a long time. And the Russia-Ukraine war, 1 year back the war started, till now it is continuing. There is no let up in the war. And the only positive I see in the global economy as well as and in the overall thing is that the natural gas price has come to pre-COVID level. Natural gas price which went up very sharply, and it affected a lot of European countries like Germany, UK and all. Now that price has come down a lot because of falling natural gas prices. Mostly in Germany, the power prices also will start coming down. So that is one positive which has happened, where no media is highlighting this one. And if you see the indices, Nifty, Sensex, both are down by almost 2.5% in the last 1 month, and mid cap and small cap are down by 1%. Nifty and Sensex by 2.5%, and Nifty mid cap and BSE small cap fell by around 1%. So it's a grinding market. But what we see is that we are not seeing a big fall in stock prices. Even in this market, we are seeing a lot of stocks going up, and we don't feel like we are in a bear market. It's a sideways market, what we are seeing now. And in the latest news which we had in the last 2 days was there, 16th largest bank in US that has shut shop, which is the Silicon Valley Bank. This bank mainly concentrates on mostly the startups, and their finances they give for most of the startups in the Silicon Valley has account with this Silicon Valley Bank, and it is the first major casualty on sharp increase in US interest rates. Just 1 year back, the interest rates in US was almost zero. Now in the last 1 year, interest rate went up very sharply, one of the sharpest increase in interest rates in past many decades. And the first casualty because of the sharp increase in interest rate is the Silicon Valley Bank. The main reason why the bank has collapsed is due to asset liability mismatch, which led to liquidity crisis for this Silicon Valley Bank. What is in by asset liability mismatch is that their main liability is the deposits, which are short term in nature. One minute. There is some technical issues is there. Asset liability mismatch led to liquidity crisis for Silicon Valley Bank. Okay, now it has got sorted. What is in by asset liability mismatch? The main liability for all banks are the deposit money which they are getting it. That is the liability because they have to pay it back. The assets, the money they have lended to their clients, as well as the bonds they are holding, they made investments. These are the assets. In case of Silicon Valley Bank, what has happened is that their assets were of long-term in nature. They mostly bought mortgage-backed securities, which are of a 10-year period. Whereas the liability, which are deposits, that can be taken by the deposit holders anytime. Now, what happened was that due to the slowdown in the startup IPOs, many startup IPOs which put deposits in this bank, they started taking out money deposits from this bank, and banks liquidity got squeezed. So in order to meet the deposit redemptions, they sold some mortgaged backed securities at the loss. Why they have sold at the loss? Since interest rate gone up, generally if interest rate goes up, the bond price used to fall. So in that way, since sharp increase in the interest rates led to fall in the mortgaged backed securities, and because of the fall in mortgage backed securities, they booked some 2 billion losses in that. In order to fill that losses, they tried for fundraising, which did not happen, and that led to huge negative news in the bank, and some doubts started coming out, and many startup companies which has put deposit, they further took money, and that led to sharp fall. That led to trust deficit, and because of that, the bank could not able to meet the redemptions, and due to this, the Silicon Valley Bank has due to this, the Silicon Valley Bank stock prices fell very sharply, and finally what happened, US banking regulator, they took over the Silicon Valley Bank yesterday night. All this has happened in the matter of 2 days only. Just 4 days back, Silicon Valley Bank was ranked best US bank in the Forbes magazine, and within 4 days, the bank collapsed. So that is how the situation has happened. But what we see is that this bank shut is totally unwarranted, because they have assets more than the deposits, and but due to the short-term liquidity crisis, the bank was used to shut down. But this event we cannot compare with the Lehman crisis movement which happened in 2008. Both are completely different, because Lehman crisis had a lot of bad assets and subprime assets, whereas this bank mostly had mortgage-backed securities which are good, but due to sharp increase in interest rates, there was fall in prices, and that is only for short term. In future, if interest rates comes down, means naturally again the mortgage-backed securities prices will go up, and if you keep the mortgage-backed securities for 10 years, you are not going to make any losses, you will get some interest also. But due to asset liability mismatch, this bank has shut, but this is only a temporary, and what we expect is that it is not going to be like a Lehman crisis which we saw in 2008, which led to huge collapse in the market. And this is the chart of the Nifty. In October 2021, Nifty touched around 18,600, and if you see now, the index has still lower than what we see in October, during October 2021. Almost for 18th month, the index is going on consolidation or sideways movement, and we expect that in near term the sideways movement is to continue, because as of now there is no major positive news in the market. Moreover, the recent shutdown of the Silicon Valley Bank may be negative in near term. One positive thing happened overnight was that after the Silicon Valley Bank collapse, now there is a perception that in March 22nd meeting, US Fed may increase interest rate by 25 basis point only in order to boost confidence, because after 2008, this is the first big collapse of a bank. In 2008, Washington Mutual Bank collapsed. Now, after 15 years, another big bank, the Silicon Valley Bank, has collapsed. It is the 16th largest bank in US. So what we expect is that in near term, market may remain consolidation. We don't expect a sharp fall in market, but we expect consolidation to continue for another 3-4 months. And after that, only we will come to know what is the action of US Fed, and based on that, market movement will happen. One important phenomenon we can see is that the news flows related to companies has reduced considerably when compared to last year. Last year, during same time, every day we used to get a lot of news flows related to companies. Some order wins, some contract signings, some fundraising program. Like that, individual companies used to give a lot of news, but now that has completely come down. Maybe more than 40-50% it has come down, the news flows related to companies. Even in CNBC, you can see that in the morning they used to tell the stocks in focus. In that, if you see that there are no major companies which are in focus, because there is complete absence of individual companies news flows. Most of the news flows which we are reading now are related to macros like inflation, like US Fed action, like that. Most of the news flows are coming now. On individual company related news, it has completely dried out. Even the analyst meet presentation uploads in BSE and NSE exchange, that are relatively lower when compared to what it was 1 year back. It's a normal phenomenon. Typically in bear market or in sideways market, the news flows related to companies used to come down a lot. That has happened now also, because only when market goes up, even management will be interested to give news to the exchanges and to the media. Now markets are sideways and they show little interest. I have seen that many companies, they used to conduct analyst meet only during bull market, and in bear market they don't care about it. Not even question, they give answers to the questions made by the analyst. Like that, many companies are there. When markets goes up, they will again start giving the presentation, and they will start conducting the analyst meet. And that usually happens only when the stock prices are going up and when the market is on the bull territory. It's a normal phenomenon, and now it has again happened, where the news flows related to companies has reduced considerably. Even I found it difficult to make the presentations because for this month, because the news flows were very less. Just in the last 2 days, we are seeing the news of this Silicon Valley Bank news. If you kept aside, in the last 2 weeks, there were not much news flows. We expect that the news flows continues to be lower in the coming weeks also. Only from April onwards, we will start seeing some movement based on the results and other things. Till then, there will be complete lack of news in the market. One positive event which has happened in the last 2 weeks is that the Adani shares has bounced back from the bottom. The main reason why the Adani shares have gone up is that GQG and a big investment of firm has invested almost nearly 2 billion into 4 Adani Group companies. Actually, what they did was that promoters of these 4 Adani Group companies, that is Adani Enterprise, Adani Transmission, then Adani Port, then Adani Green. These 4 companies, promoters, Adani basically, they sold their promoter stake to this GQG partners for 1.87. In one company, they sold around 2%, and another company, they sold around 4%. Between 2 to 4%, the Adani promoters sold, and they raised around 15,000 crores worth of rupees. And basically, the promoters sold it at a time when the Adani Group was in a big distress. And this has given a big relief to the market, because the entire market was coming down because of this Adani issue. The fundraising is a big positive and a sentiment booster for the Adani Group as well as for the market. And promoters, with that money, they have released some pledge, and it is expected that in the future also they may sell some more stake to unpledge their shares and they have some liquidity crisis, and they may use that money to sell the liquidity crisis. And GQG partner chief, that is Rajiv Jain, they explained their investment rationale in the Adani Group. Entire foreign investor communities were completely negative on the Adani Group shares after the Hindenburg report came. Even the Norway Sovereign Wealth Fund, they completely exited their investment in the Adani Group. And this investment gives some confidence to the investors for on sidelines to invest in the Adani Group. And GQG partners explained their investment rationale in many media why they have invested in this company. They told that most of the Adani Group assets are replicable. That means, for example, they have Adani Group manages this Mumbai airport. So another Mumbai airport is not possible. So that asset is not possible, and there will be no competition for them. Like that, many assets they are holding which are unique, and you cannot replace that asset. And that is the reason why they have invested in this Adani Group. And they are following this Adani Group for the last 5 years, but the valuations were very high, and that is why they stayed away from it. Now the valuations have fell to a reasonable level, and that has led to their investment in the Adani Group. That is the investment rationale they have given. And they says that Adani Group is growing very, very quickly, and they are basically long-term investors. And if you see that GQG partners, they are holding this HDFC Bank shares for the last 25 years, and ITC for the last many years, more than decades, they are holding this. Like that, when they invest in a company, they generally hold for multiple years, and most of the companies like that. And if you see their Indian portfolio, they are invested in the bluest of the blue chip of Indian companies: HDFC Group, Infosys, ITC, SBI. Like that, they have invested most of the bluest of the blue chip of the Indian companies. And their investment in Adani Group is surprising for many, but they have explained their investment rationale very, very clearly. So now, after the investment, what is next for Adani Group? So in our opinion is that we are not going to see a big rally for Adani Group shares in near term, because they have grown very aggressively in the last 2-3 years. They took a lot of debt, and it will take some time for them to normalize. Immediately, you cannot solve the problem. That too, in this high interest scenario, where interest rates are very, very high, and they have a lot of debts also. At a company level, they have a lot of debt. At promoter level also, they have a lot of debt. They have took debt and bought this Ambuja Cement almost over 50,000 crores 1 year back. And we expect that waves of positive and negative news will keep on coming on Adani Group. Yesterday night, I read that Adani Group, where they have pledged the shares to Ambuja Cement, where they have pledged Ambuja Cement shares to foreign banks. They have asked them to sell 3 to 4% of Ambuja Cement shares. That news I saw it. So it may be slightly negative for Ambuja Cement, because the Adani Group will keep on raising money. Almost 50,000 crores they have spent for buying this Ambuja Cement. They have invested in warrants also, which means that they will keep on needing money at least for next 1 year. When they took the loan, the interest rates were lower. After they took the loan, interest rate has gone up, and that means the additional expenditure they have to make. Moreover, all the loans the Adani promoter took was on foreign countries. So there is a foreign exchange risk also there. Interest rate has gone up, and because of that, they keep on needing funds. So we expect that the problem unlikely to get solved in near term, and we expect consolidation to happen in near term in Adani Group stocks, unlikely to go up very sharply. And the other major thing is that groups growth will get moderated. In the last 2-3 years, they have grown aggressively. Most probably, the growth will start coming down in near term. That will happen. The one important observation we can see is that if you are closely watching the market, 1 year back, 2 years back, one theme was very favorite among many institutional investors, which is called ESG Team, environmental, social, and governance. Most of the companies were buying companies based on this ESG, that is, companies which are focused on environmental as well as governance and social. And it was very famous till early 2022. In fact, many thematic funds were launched on this ESG theme. Even in our domestic market, also you can see some of the mutual funds they launched based on this ESG theme, and many PMSs were there based on the ESG theme. Now, once this Russia-Ukraine war came, the ESG theme got punctured. Mostly in ESG theme, what they used to do is that they avoid companies which are making pollution to the environment. That means they don't buy companies which are in thermal power, which uses coal to produce electricity. That means burning of coal is a negative. It will be highly polluting. And when you dig coal from the mines, it will be causing pollution. So they don't buy the companies related to coal. Similarly, they don't buy companies related to oil, because that is also pollution. They buy companies which are related to renewable energies like solar, wind, like that. And these ESG theme based companies that are. But once the Russia-Ukraine war came, everything forgot this ESG theme, because there was a huge shortage of oil and gas, which led to sharp increase in the oil prices. And now what happened? Everyone started buying all this oil companies and the thermal based companies. Everyone started buying, and that led to some antithesis on this ESG governance theme. And most of the companies which are in this anti-ESG theme, they did very well. In fact, this GQG partners, they invested most of the companies between 2020 to 2022 in anti-ESG theme companies. That gave them a huge outperformance in the last 2 years. And the GQG partners, now they have invested in this Adani Group companies. Now, we feel that ESG will be adopted, but it will be on the slower pace. And Europe is more concerned about this ESG theme, and they did not stop it. They are continuously implementing it. Except Europe, no other countries are very much interested on this ESG theme. ITC, one of the biggest casualty of this ESG theme, he hugely underperformed between 2020 and 2022. Everybody will be knowing that. There are various reasons was told for the underperformance of ITC between 2020 and 2022. Some of them said that the MD and CEO is not capable of running the company. They told, and they said that company has to demerge cigarette division into separate, hotel division into separate, and FMCG into separate. If they don't do it, then ITC will continue to underperform. And then they told that FMCG division is not doing well. And they told market, and we signed a social media that company was investing in the hotel business, which is highly capital intensive. Like that, various reasons was told for the ITC underperformance. But what happened 2 years later? You see that ITC was the biggest gainer in the Nifty in the last 18 months. Between October 2021 and March 8th, if you see that Nifty has come down by around 3%. This data I took it 2 days back. And if you see that ITC, the stock price, which was 246 during the same period in 2021, now it has gone to 392. Additionally, the company has given 3 dividends, around 16-17 rupees. The company has totally given dividends during the same period. Without taking that, ITC has given almost a 60% return in the last 18 months, whereas Nifty has given negative return. And even now, ITC is outperforming the market. And I still remember that ITC and SBI was the biggest marked stock during that period, 2020 and 2021. Both stocks were underperforming a lot. And after that, if you see in the last 1 year, 1.5 years, both stocks has done phenomenally well, ITC and SBI. In fact, ITC weightage, if you see that it has 6% weightage in the Nifty, it has around 6% weightage. This HDFC and HDFC Bank combined together have around 15% weightage in the index, and the next highest weightage is the Reliance, which has around 10% weightage. Then you have Infosys, then you have ITC. So somebody who are not owning ITC in their portfolio, it will be very difficult to beat the Nifty. And we are seeing that many mutual funds and many individual portfolios were underperforming, mainly because they don't have this ITC in their portfolio, which has around 6% weightage in the Nifty. And ITC has done very well, whereas Nifty was on a sideways movement. And this is some of the memes on ITC 2 years back. If you have seen the Twitter, Twitter or Facebook, if you see that daily, you can see memes on ITC as well as SBI. So here in the first picture, we can see that market has been going, markets were going up and they are all running this side. On the other side, you see ITC is going on the opposite side. At that time, ITC was the biggest underperformer. And it never used to cross 200 at that time. Whenever it goes above 200, again selling will come. It used to fall in. And the second picture was that Amir Khan was very happy as ITC crossed 200. So these types of memes, we saw it many at that time. So one thing it reminded everyone is that we should be very humble in the market. We should not feel that we know everything and the market and we know everything about the market, and we can mock those who are underperforming. It's a very wrong. We should be very humble. Anyone can go wrong anytime, because in market we are betting on the future. No one knows the future, and everyone told that the consumption of cigarette is going to come down because government is very strict on cigarette advertisement. Like that, many stories were thesis were built on ITC, and at that time, and the stock underperformed. Now everyone forget that how come the stock has gone up within 2 years this much, in spite of all the negative stories built in the last 2 years. What I have seen in so many years is that whenever stocks goes up, some stories will be built why the stock is going up. Similarly, whenever the stocks comes down, the same type of negative stories will be built and justify that why the stocks are coming down. This I have been seeing for the last 20-30 years, and market participants will keep on justifying why the stock is going up, why the stock is coming down. Even for 4PE, 5PE stock, you can justify the lower valuation. Similarly, for 80PE, 90PE stock, you can justify why the valuations are very high. So one thing is sure, that we should be very humble in the market, and we should not mock anyone who is underperforming. At any point of time in the future, we may also will be on the same platform. So this led to one big question: are market very efficient? If you read 2 weeks back, Warren Buffett annual report, every year he used to give a report about the market in the AGM. So in that he says that efficient market theory exists only in the textbook, he said. What is in the efficient market? Market knows everything, and whatever negative or positive news is there, it is in the stock price. That is what called efficient market theory. And efficient market theory also says that it is very difficult for fundamental analyst or technical analysis to make money, because all the news flows are in the price. That means the stock price are priced to perfection, and somebody who is buying based on future earnings means the stock price has already discounted that one. That is what efficient market theory says. And textbook says that markets are very efficient. That's what textbook says. But in reality, what I find is that the stock price either overreacts on both upsides and on downside. Just 1 year back, we have seen that so many stocks overreacted on the upside. On the upside, we saw that IEX went up to 300 rupees, and the justification given at that time why IEX went up to 300 rupees, that all PSU electricity board, they will start buying electricity from the power exchanges only in the future. They won't buy right now. They are buying through long-term power purchase agreement. That will go away in the future. All the electricity distribution companies, they will buy power from only from the exchanges. That will lead to huge increase in the volumes. That was the justification given for the IEX. But we know that after 1 year, what has happened? IEX stock prices fell by 50%. Similarly, the stocks like Land Pharma, Laurus Lab, like that we can tell n number of companies where stock prices overreacted on upside. Similarly, on downside, you see so many companies overreacted on the downside. To the example which I told previously, ITC, PSU, many PSU banks, they overreacted on the downside. So in reality, stock prices tend to overreact on both upside and downside. That is where the opportunity for the market participant exists. If market is very efficient, means it's very difficult to make money in the market. So inefficient market only gives opportunity for market participants to make money. And right now, what is happening? Social media and over information is there, and it will keep on pouring. So whenever we read a same news many times, our mind will get influenced to overreact, and that is leading to a lot of overreaction in stock prices also. Now yesterday one bank has collapsed, and Silicon Valley Bank has collapsed. If we keep on reading that news, means and we will tend to overreact on negative side. And because of this social media and over information available to everyone, in my opinion, market has become highly inefficient, and stock prices are overreacting both on upside and downside. But that is the one which gives opportunity to market participants. And this is the bond yield chart. I initially told that the domestic bond yield has inverted. What is meant by bond yield inversion? We all know that the bond has various tenure. The 1 year, lower than 1 year, it is called treasury bills. Government raises money through 2-year bond, 5-year bond, 10-year bond, then long-term bonds also, that 30-year bond, 39-year bond, like that various tenure bonds are there. For short-term money, they will raise through treasury bills. 90-day treasury bill is there, 182-day treasury bill is there, then 364-day treasury bill is there. So generally, when the economy is in the normal state, what used to happen is that the treasury bill interest rates will be lower. 90-day treasury bill will be around 4.5%. Then 180-day treasury will be around 5%. Then 364 treasury day 364-day treasury bill will be around 6%, like that. So whenever the tenure goes up, the interest rate used to goes up. That is usually the bond market phenomenon. Whereas now what has happened is that suddenly the short-term yield has gone up. That is 364-day treasury bill. Their interest rate now has almost gone above the 10-year bond interest rate. And if you see that in January, 364-day yield was around 6.9, whereas the 10-year bond yield was 7.35 range. Now in the month of March, what has happened? The 364-day treasury yield has spiked to 7.45, whereas the 10-year bond yield is around 7.41. That means the short-term yield has gone above the long-term yield. This is called inversion, bond yield inversion. This generally used to come when there is near-term stress in the economy and when there is near-term liquidity tightness in the economy. So in the few months back, it has happened in US. Now it has happened in our country also, and which indicates that there is some near-term stress in our domestic economy. And we expect that because of this liquidity tightness in the market, in near term, the consumption may come down. And that is what this bond yield inversion indicates. And in 2005, it has happened. After 2015, this bond yield inversion has happened. So almost after 8 years, again, the bond yield inversion has happened now between 364-day treasury bill and 10-year bond yield, which indicates that some big liquidity tightness is there in our market. Generally, March used to be a huge liquidity tightness month because of payment of advance tax and other government aggressive borrowing. Generally, the March used to be a highly tight month on liquidity front, but this time the yield has overshooted it. In April and May, we will come to know whether it will the yield curve will normalizes or it will remain inverted. This is the US Treasury yield, and if you see that 2-year bond and 10-year bond around 2022, before 2022, the yield was lower. Between 2020 and 22, the 2-year yield was much lower than 10-year yield. Then it started climbing in 2022, and it was going in parallel. And a few months back, the 2-year yield has gone above the 10-year yield, which indicates that in US also the yield curve has inverted, and the yield curve inverted in US few months back, and in our country it has happened just now. In the month of March, the yield curve has inverted, which indicates that near term there will be stress in the economy. Historically, if you see that in US, whenever the yield curve has inverted, 3 to 6 months down the line, the recession used to come. And this is the yield curve for various tenure. And if you see that for various tenures, it has almost become flat. And in this chart, the first one, cyan color, it was taken during August 2022, and at that time it had a normal yield curve where the lower yields were at lower level, a higher tenure gradually were going up, and there was some curve. But if you see now, it has become almost flat in our country, which means that both lower tenure as well as the long-term tenure, everything is now trading at the same interest, which means that the yield curve has flattened a lot. And short-term interest rate, it is slightly above long-term interest rate, where the inversion has happened at the lower tenure yields. It's a very interesting chart. If you see that, we all know that our country imports more than what we export. That is, every month government used to release the export-import data. Our imports used to around 45 to 50 billion, whereas our exports around 30 to 35 billion, which will give a gap of around 20 billion. Around 20 billion trade deficit every month. So this trade deficit has to be financed by someone else. Otherwise, rupee will weaken significantly. Either it has to be financed through service exports, or through NRI remittance, or through capital flows. And if you see that one of the major major financing of trade deficit is due to remittance from NRIs, and many NRIs are working throughout the world. Many are in Gulf countries, many are in the US, and many are in Europe, where they send money to the firm. And in that, if you see that money has gone up very sharply in the last 3-4 years. 3-4 years back, it was just 69 billion. And now in the last calendar year, it is almost 100 billion. Whereas the FDI also one of the biggest source of capital for our country. And the FDI is almost stagnant for the last 2 years. In fact, in calendar 2022, FDI was lower than what it was in 2021. And because of this, NRIs is sending money to our country. India is somewhat in a better place. We all know that the Pakistan and our neighbors, how they are struggling. Pakistan is struggling to get around 1 to 2 billion loan from IMF and from China, whereas our NRIs are sending money. We have sent almost $100 billion last year. In spite of all the talk about the brain drain from our country, because of NRI, India is in a better position because almost 100 billion worth of US dollars they have sent to the native country. This is one interesting chart where the capex they took from Motilal Oswal presentation, where the capex is still lower than what it was pre-COVID. And if you see that India's fixed investment is just 28.9% of the GDP for the first 9 months of the current financial year, but the same thing was around 29 before COVID, 29% COVID. So still the gross fixed investment is not happening in our country, and still it is lower than the pre-COVID level. And in the second chart, we can see that who are making investment, and in that you can see that central government is spending a lot. It was pre-COVID, it was around 5.8%. Now it is around 7.3. Whereas the other segment, it was lower. The state government, the spending has come down from 7.7 to 5.5. So the center is making a lot of investment when compared to pre-COVID level. And the other thing, corporates also doing a lot. From 44, it has gone to 47, but still lower than the pre-COVID level. Still, a lot of investment is needed, and we expect that more will come in coming years. But in near term, we may see some slowdown in the investments due to a high interest rate as well as the slowdown in the global economy. GDP growth, it was lower than expected. The expected was 4.8 in Q3 FY23, whereas the market was expecting around 4.7%. The actual data came was 4.4. The natural gas price, as I said previously, that natural gas price has collapsed, and you can see that now the prices are almost at the mean level what it was many years back. Historically, if you see, natural gas price is a highly volatile commodity. It used to go up very sharply, then it will fall very sharply. So many times it has happened. We can see the previous chart also. It is a 10-year chart. Many times you can see in 2015, you can see sharp increase in the natural gas price. Again, it used to fall. Then 2019, it went up very sharply. Again, it fell. Then in 2023, 22, you can see that after the Russia-Ukraine war, the natural gas price from $3.6 per MMBTU, it went to around more than 9, almost 3 to 4 times it went up. Now it fell much sharper than what it went up. Now it has come to $2.62 per MMBTU, which is almost what it was many years back. So the fall in natural gas price is the biggest positive, not only for our country, for the entire global economy, because many power plants in Europe and all runs on natural gas. Even our country, if you see that, based on the natural gas price only, many things are fixed. For example, the fertilizer subsidy, in that they take natural gas price into account, and many industries also use natural gas for fuel purpose, and city gas distribution companies, many of them, they use natural gas to distribute through their city gas distribution. And in Delhi, the main fuel for the transport is the natural gas. So the fall in natural gas is very positive, and it has to be sustained in this level, and it will be benefit for many companies, as well as many of them, if prices are attractive means, then again many of the industries, they will switch to natural gases. And this is the domestic liquidity, and if you see that FIIs were continuously selling it, and in FY22 they sold around 1,41,000 crores, and FY23 they sold around 36,000 crores they have sold. And now on the other side, if you see, mutual funds are consistently investing in the market. So whenever FIs were selling, mutual fund used to buy it. Whenever FIs buy, mutual fund used to sell it. In FY21, FIs bought around 2,73,000 worth of shares, whereas at the time mutual fund sold 1,20,000 crores worth of shares. They sold it. So the mutual funds, they are now the deciding force on the domestic liquidity. Whereas previously, if you see that FIs were on the driver's seat, whenever they sell, market used to fall very sharply. But now that is not the case. There is a counterbalance is there where mutual funds, and in spite of last 2 years of almost 1,80,000 crores selling by FIs, the market did not tank, and it was just consolidating thanks to mutual fund inflows. And this is the FII activity. 18 billion they sold last year. Now they have sold almost 4.3 billion. And we expect that the current year also FII investment will end into negative. So the 2 consecutive, just another 20 more days is there for current financial year to end. So just 20 days is left. So 2 consecutive years of FII selling is very rare in our market. Generally in the past it hasn't happened, but this time it has happened. But because of mutual fund inflows, there is no major shakeout in the market in spite of huge FII selling. Mutual fund flows, yesterday only data came, almost 15,000 crores net inflow is there, and 13,500 crores SIP inflow is there. Additionally, 2-3 NFOs came last month. Canara Bank Mid Cap Fund, Tata Multi Cap Fund came, then Aditya Birla Multi Asset Fund came. So these and all added the net inflow into mutual funds, and overall is a decent inflow. 14,600 is a decent inflow into our markets. So in spite of all the negative things, the long-term story for our country remains intact. And this is one of the data comparison between 2000 and 2021. If you see that Indian ranking during the year 2000, the size of the industry was 12th rank. Now after 20 years, it has become 5th rank. Similarly, agriculture, if you see, it was 13th rank in the year 2000. Now on the global size, if you see, we are the 7th rank. Services from 3rd to 2nd. Consumer spending from 15th to 5th rank in the last 20 years. Savings from 12th to 7th. Savings rate from 12th to 4th. We all know that India is one of the highest savings country in the world. Investment from 7th to 3. FDI from 10th rank in year 2000 to 2021, the 4th rank. And after 10 years, if you see, if you plot the same table for 2030, definitely we would have improved in all the industries, at least by 1 to 3 notches higher. Our rank would have gone higher if we take the same data in 2025 or to 2030. So the long-term story for India remains intact. So whenever there is correction, it's a great opportunity to buy. And in my history, what I have seen is that generally the huge profit will be made only when stocks are bought during sideways movement or during correction. In bull market, everyone makes money, but when market turns, most of the money made during the bull market, most of them will lose. But if we invested during bear market, in near term, it looks like that our investment is not yielding return. But if you see after 2 years, 3 years, whatever we bought during sideways market or during the bear market, most of the shares, it would have gone to profit. So what we are advising to our clients is that always use the sideways market or bear market to build the portfolio. That is what we are advised. India long-term story remains intact. If you see globally, the countries, that is the European countries, most of them are getting old. The economy is stagnant. If you see Japan, the same issue. Economy is stagnant. Population is coming down. age population is going up. Whenever the age population is going up, means naturally the consumption economy will slow down or will start grinding down. That is what happening in Japan. Even in China, if you see that the population has become stagnant and the aged earning population is going to shrink in coming years. So the only biggest positive in the world is that India has a growing population as well as the earning population, and the demographic is extremely favorable for the economy to grow. So in the next 5 to 10 years, definitely we will grow and the ranking will improve. And markets, we all know that they generally like companies which are growing companies and they give high valuation also. So it is better to utilize this a sideways or fall in stock prices to build portfolio. And that is what we advise. And markets we are expecting in near term, it is going to be range bound. I am not expecting big fall in the market. Even if it falls also, it will be temporary only. And we expect market will be range bound. And it's an ideal time for portfolio building. As I said previously, market has become extremely inefficient. And whenever some negative news come, the price used to fall very sharply. And whenever some positive news comes, it goes up very sharply. So the sharp fall in stock prices give good opportunity to build portfolio. And we advise investors to gradually accumulate it. Definitely 1 to 2 years down the line, most of the stocks will be in profit. So this is what my presentation this month. Actually, I did not got much data due to, as I said in the slide, that the number of companies reporting news has come down a lot. And next month, I try to prepare a very good presentations with more data points. Now we will see the recommendations. So now we are recommending this five stocks based on the news flows we got on the last 1 month. We are recommending this 5 stocks. The first one is HDFC Bank. We all know that HDFC is going to be reverse merged with the HDFC Bank, and it will become a big conglomerate. Because right now what you see is that many subsidiaries, there's a insurance arm, the insurance arm, mutual fund arm, everything comes under HDFC. Once the HDFC gets merged with HDFC Bank, means then everything will come under HDFC Bank. And we see that the HDFC Bank is doing well and they are consistently growing around 28%. And the valuation also right now little reasonable when compared to what it was 2 years back. And one can invest with a long-term view. The second stock, BEL, where in this correction, if you watch closely, the PSU companies, they have greatly outperformed the market and significantly outperformed the market. And BEL is a good long-term bet. The third company is the IT company, Sensor Technology. And during the IT meltdown fall, stock price fall from almost 500 rupees, the Sensor Technology fell to around 200 rupees. More than 50% fall. It was one of the worst performing stock last year. Now we are seeing some momentum returning back. And one of the reasons why Sensor Tech has some momentum is that they have this artificial intelligence business. And if you see that after this chat GPT, everyone started focusing on the artificial intelligence theme is getting importance globally. And Sensor Tech also has some business on artificial intelligence. They acquired one company a few years back on artificial intelligence. And because of that, some momentum is returning on Sensor Technology. And one can consider in mid-cap IT space. The fourth one, it is a one rating company we are recommending, ICRA. So whenever there is liquidity tightness, whenever the interest rates are going up, generally the rating company used to benefit a lot. And most of the companies come for rating because many companies will be raising money through NCDs and through bank loans. So for that, they need this rating to raise money from debentures or through bonds. It should be rated. So rating company will get some fees for the rating. Right now, one phenomenon which we are seeing is that many corporates they are asked to raise money through bonds, not only from bank loans. Suppose if a company needs 1,000 crores worth of loan, means what I'm hearing is that regulator is asking the companies to raise some portion of the loan through NCDs in order to strengthen domestic bond market. Regulators are asking to companies to tap the bond market. If a company wants 1,000 crores, means 900 crores they raise through bank loans. They take bank loan. Balance 100 crore they will issue bonds or NCDs they will issue. So for that they need rating. So rating company, they will give rating and they will get some fees. So the rating companies generally benefit when there is some liquidity tightness in the market, because many companies will come for raising funds, which will benefit the rating companies. So 3 rating companies are listed in our markets. One is the CRISIL, which is the subsidiary of S&P USA. The second one is the ICRA, that is also a MNC subsidiary, which is the parent is the Moody's rating. And third one is the CARE rating, which is the domestically grown company. And we are positive on all the 3. And if you see that CRISIL and ICRA, apart from rating business, they have some research oriented income also. Whereas on CARE rating, 100% their business depends upon the rating only. Their research business is actually showing losses, and they want to try to escalate the business, but that did not happen as expected. And CARE rating business also is expected to do well. Actually, previously we have recommended a CARE rating in our second Saturday meeting, as well as to our clients. So in rating companies, one can consider ICRA. Valuation is available around 30-35 P. It is available, and one can consider buying ICRA. The 5th stock is Petronet LNG, where the valuations are reasonable, and the company also used to give good dividend. Right now, I told that the gas prices has fell a lot, and the Petronet LNG may buy some spot cargoes. They import it. And they import it, and the business used to go up. There is some power cut is there. Please be online. So all the 5 companies we recommend to buy. And Coromandel and Sundaram Finance almost flat. So overall, the portfolio has gone up by almost 3%. It has gone up against the Nifty negative of around 2.5%. So reasonably, we have done well. Please be online for Q&A session.